The next loan I want to talk about is conventional loan. Conventional loans are non-government backed loans like FHA or VA. Generally speaking, you'll need a higher credit score, typically minimally starting at 620 or better to qualify for a conventional loan. You can't have had a lot of outstanding negative debt in your past. That's to say excessive medical bills or credit card payments, things of that nature, charge-offs, write-offs, things of that nature. So generally speaking, you need tighter, cleaner credit to qualify for a conventional loan. Okay, the last loan that I want to talk about is a USDA loan, or United States Department of Agriculture. This is very similar, or one would consider a conventional loan. At a minimum, the requirements are it be for your primary residence only. You have to be a U.S. citizen or legal permanent residence. Your median income cannot exceed 115% of the rural area that you're thinking about purchasing in. You have to have a clean credit history, no late payments within the past 12 months, and generally your credit score that's required is 640 or better to qualify. So now that we have these types of loans under our belt with respect to the definitions and so forth, which these are generally what you're going to see out there, let's move forward. So one last thing that I want to touch on with respect to mortgages, and that's interest rates. They can either be fixed or adjustable. A fixed rate is basically a mortgage that has a fixed rate from the beginning of the loan throughout the life of the loan. So you may have a mortgage that starts out at 5%, it's going to be 5% for the life of the loan. An adjustable rate mortgage, or an ARM, which is an acronym that you'll see, an adjustable rate mortgage has a rate that varies, that may change based on different situations and scenarios throughout the life of the loan. So you may start out at 5% and it may graduate up to 6% at some point. The ideal scenario, unless an adjustable rate mortgage is in your plan and you have an exit strategy, you want to be very, very careful. A lot of people got into trouble in the 90s with adjustable rate mortgages and so forth because they started out at a decent rate. They would qualify at a lower rate, say a 3% start rate, and then it adjusts or it goes up over 5 years. And a lot of people had payments that were doubling and tripling, and they were getting into trouble. So you want to be careful with an adjustable rate. They have their place, but you have to have an exit strategy and a plan.